I'm Matt. I'm an MBA student at Rider. And, excuse me. Anybody here seen the movie Wedding Crashers? Yes?
Yeah.
Awesome. All right. It's a little bit of an unorthodox intro, but let me take you to the scene in the movie when the extended family gets together. The Wedding Crashers are there. Christopher Walken's at the head of the table. This is after the wedding that took place earlier in the day. And nobody knows who these Wedding Crashers are. Christopher Walken says, "What do you guys do for a living?" And Owen Wilson says, "Oh, we're venture capitalists from Vermont." So he says, venture capitalists, the backbone of the system. And this exchange is obviously lost in the context of the movie. But if you think about what he said, the backbone of the system, it's really pretty profound. I mean, there's never been an idea that's transformed into a product, service, large business or small business, that didn't at one point in time require an infusion of capital. And capital comes in many different forms. I'm here to talk about capital in the form of private equity. I'm going to define for you what is a private equity firm. And I'm just going to outline a few of the central roles they play in the marketplace. So what is a private equity firm? A private equity firm is sometimes run by just one individual. A lot of times it's many people. They get together and they raise money from investors. Those investors are private individuals, sometimes called angel investors. A lot of times it's institutional money. It comes from like university endowments, pension funds, insurance companies, sometimes countries. And what the firm does is they bundle all this money together, they create a fund, and then they allocate that fund in the form of investments into small companies. In return for those investments, the fund holders, the people that invested in the fund, receive shares. And the shares represent ownership. And ownership is the equity portion of private equity. Okay. Now these shares, they're not treated as common stock like what you might think on the New York Stock Exchange or NASDAQ. They're not traded on an open market. They're held privately. They're very illiquid. There's not an open exchange. And they tend to be held long term. So that's what makes them private. So that's the private portion of private equity. So now that we understand what a private equity firm is, let's talk about some of the central roles they perform. The first one, and probably the biggest, is providing expansion capital. So who would be in the market for expansion capital? These are often startups, small businesses that are poised for growth but don't have access to traditional forms of capital. A guy that I interviewed for this, Jim Medallia, he's been a CEO of a number of companies, most recently a company called Charter Private. And he indicated that in their startup phase, their balance sheet didn't support access to a line of credit. They couldn't get debt financing from a bank. So private equity was really the only option. And once these firms decide to make an investment in a company, they're looking to maximize share value. So they're looking for a company that can make a massive social imprint in a relatively short amount of time. Those tend to be technology companies, biotech, pharmaceutical, etc. So let's pretend the fund's been allocated. Do the private equity firms kind of sit back, cross their fingers, and hope everything goes okay? Of course not. Which brings me to the second role that they play, and that's providing management expertise. A lot of the people that run the funds have spent time working in industries. They develop sector expertise, or sector specialization is what they call it. And they've got contacts, they understand competition, and they can act as an asset to the companies that they invest in. In addition to being an asset to these companies, they provide investor confidence. So the investors can feel good that their investments are being well looked after by the fund. I use the metaphor here of the manhole cover. They're helping the business grow and avoid any the pitfalls along the way that might help them from growing. So investors bring about the third central role, and that's obviously to deliver return. After all, what's the point? At some point in time, the private equity firm needs to monetize those shares. Remember, they're really illiquid, so they have to determine how to get that money out. It's called an exit strategy, and there's a number of clever ways to do that. A couple of the most common would be to have the company actually buy their own shares back. The other option would be to take them public. So they take the private shares, convert them to public shares, and trade them on an open market. Once that's completed, the fund resumes its original state, and the firm can distribute the funds in the proportional ownership as when they started. So let me kind of recap this and put it in a nice tidy package for you. Private equity firm is a group of individuals that raise money from individuals or institutions. They gather that money in a fund. They allocate the fund in the form of investments in companies. They help those companies grow. They provide management expertise. And at some point in time, they execute an exit strategy and deliver investor return. Sorry about that. Okay. So this is a really powerful process when it works. It doesn't always work, but when it works, it's really powerful. And the evidence, of it is all around us every day. And the great thing about being consumers is that we kind of get to sit back. We don't even necessarily have to participate. We just get to show up and take advantage. And so I think in that way, we're all a little bit like wedding crashers.